Since the start of the year, the dollar has fallen 11%, and this fall in the dollar has occurred despite the US having significantly higher short-term interest rates, which in theory should be boosting the dollar's value. Investors have become worried about the US instability, higher tariffs, the threat of inflation, lower growth, and now a rapid rise in US debt. Although US debt was set to rise rapidly anyway, the recent Big Beautiful Bill will see US debt rise an extra $3.3 trillion in the next 10 years. By 2055, debt will be over 170% of GDP, and this assumes no major external shock or economic slowdown, which of course is quite possible. Now, the impact of higher deficits is that the US will spend an increasing share of GDP on just paying debt interest payments. Debt interest payments will rise to a staggering 6.2% of GDP. In the post-war period, US economic growth was averaging around 2.5%. So when your debt interest payments are double the rate of economic growth, it creates a dynamic of rising debt to GDP, which can be concerning and has long-term implications for the dollar. Now, I have been studying economics for 30 years, and every year without fail, you will see an article or video about the imminent demise of the US dollar. I never really paid too much attention to these articles because in the past 30 years, the economic fundamentals really supported the strength of the US dollar. The dollar just kept going up. However, from this year, I do tend to agree with economists like, say, Kenneth Rogoff, that this time really is different. Now, the dollar will not suddenly evaporate or crash. It will be more of a slow burn, a gradual decline. The biggest source of US government spending is Social Security. Initially, it was set up like a pension trust fund, but from 2011, Social Security's trust fund was running annual deficits, paying out more benefits than it received in taxes. But the CBO predict that the programme will become insolvent by 2032 and will run out of scheduled benefits beginning 2033. It means that by 2034, recipients will only be getting 77% of intended benefits. That's an average loss of $5,000 a year. So someone born in 1965, they will not be able to retire until they're 67, just in time for Social Security to cut payments. Social Security has unfunded obligations of $22 trillion. So come the early 2030s, with debt already rising rapidly, the government will face a tricky dilemma of either cutting Social Security payments, politically unpopular, or finding a way to maintain the payments retired have got used to. And it's not just Social Security. Medicare, which provides healthcare for nearly 67 million people, will face its own cash crunch in 2036. And this all matters for the dollar because markets are concerned that the response to this surge in debt may be to increase the money supply to buy debt, and this will reduce the value of the dollar, especially if the Federal Reserve becomes less independent in future years. Now, in recent years, the dollar's strength has been partly related to the US economy growing more rapidly than, say, the European economy. But many factors which have resulted in strong growth in the US in the past are now under threat. As a share of global GDP, the US is declining, and lower growth will see this fall even more. Like many countries, the US is an aging society. The number of people over 65 will rise from 58 million in 2022 to 85 million in 2050. That's a 47% rise. That's really why debt is set to rise in most major economies, the US especially. Now, in recent years, the US has had high levels of migration, which countered this aging effect to some extent. But this source of nominal GDP growth looks to be cut much faster than previously expected. The recent bill, by extending tax cuts, does actually provide a temporary boost to economic growth. Not very much, but after 2029, that impact fades. And long-term demographic factors all look pretty bleak. The working age population of the US is expected to fall, and that prediction was made in 2022 before new migration policy. And on top of that, in the more immediate future, the tariff war is creating tremendous uncertainty, increased costs to trade, and this will negatively affect economic growth. The stop-start US trade war, combined with rising debt, is also undermining the dollar's reputation as an international safe haven. In 1978, the US dollar accounted for 85% of global reserve currencies. Today, that is 58%. But as The Economist notes, this was expected to fall another 10% in the next decade, but the tariff war will only accelerate this decline. Back in the 1960s, the French minister Valéry Giscard d'Estaing famously complained of the exorbitant privilege of the US dollar. It meant the US could live beyond its mean, running persistent trade deficits without devaluation, low borrowing costs, and seigniorage of printing money other countries use. Even this year, we've seen a rapid rise in long-term borrowing costs for the US, which is a big deal when you consider the growing size of the deficit. And this rising borrowing costs reflects less willingness to keep buying US treasuries. In the post-war period, it was the United States who set up Bretton Woods, the World Trade Organization, and system of free trade, a system that largely benefited the United States economy, notwithstanding high-profile decline of US manufacturing jobs to China. But for better or for worse, it strengthened the position of the United States dollar as both reserve currency and currency of international denomination. But since the start of 2025, investors are bracing themselves for a sea change in US policy. Just to give one example, US and Korea signed a free trade agreement in 2012, but now President Trump is threatening Korea and Japan with 25% tariffs. And it suggests that past agreements count for little, which is a big change in US policy. Now, in 2000, foreign holdings of US treasuries amounted to $1 trillion. By 2025, that had risen to $8 trillion. Around 30% of all US debt is held by foreigners. Ironically, that's partly a reflection of the US trade deficit and the corresponding capital flows coming into the US. But if overseas investors become wary of holding all this US dollar assets, and the reason are actually many, it could be concerns over growing debt, concerns over the rule of law, fears over trade policy, also the new higher tax on foreign earnings of US income. All this could lead to people selling off bonds, pushing up bond yields, and even more increasing the cost of debt interest payments. And the worry is that this could push the US into a tipping point, where a debt ceiling is breached and an increasingly less independent Federal Reserve increases the money supply to fund the debt, create money and buy your own bonds. Now, in the 2010s, quantitative easing funded part of debt with minimal inflationary impact, at least until 2022. But if inflation is stubbornly above target and the Fed responds with effectively printing money, the inflationary impact could become much more real, and as inflation goes up in the US, that would cause the dollar to go down. Now, what could really harm the dollar is a long-term decline in the economic performance of the US economy. In recent decades, the real strength of the US economy has not been so much in manufacturing, but high-tech investment. In particular, the US's strong academic sector has managed to combine strong research and development with a capacity to translate this research into commercial success. In this sense, the size of the US and large funds of private equity have enabled the US to really dominate things like big tech and be a market leader in artificial intelligence. However, recently the federal government have curtailed funding for many scientific research programs, which in the very long term could undermine some of the US's past success. Even things like cutting back funding for the IRS could lead to easier tax avoidance and tax revenues becoming even more disappointed than predicted. Now, before we write off the dollar, we do have to bear in mind it has a long history of exceeding expectations. And firstly, there is no obvious alternative. Euro once touted as a potential, but there isn't the same level of unity or level of debt issue. Japan's economy is more stable, but it's also in decline and it has its own debt problems. In fact, the demographic problems facing the US are also faced by just about every major economy in the world. Also, a decline in the dollar's dominance is not necessarily a bad thing. Of course, there are advantages. It makes US exports more competitive. The British pound once enjoyed a similar position the US dollar holds now, but damaged by 2 world wars, the economy couldn't support the value of a pound, and it's really been declining for 100 years. Although it is worth pointing out that the 100 years decline of the pound has kind of corresponded to a relative decline of the UK economy. Also, it is quite possible that fears over the tariff war may be somewhat overblown. So far, tariffs have only marginal impact on US inflation. You would kind of need to use a magnifying glass to see the impact on CPI, although that's slightly misleading because the full effect of tariffs is yet to be seen in official data. Nevertheless, it is possible that within a year tariffs become somewhat more stable and less impact than some fear. Although I think it is fair to say that the level of uncertainty is pretty high and no one really knows what's going to happen. In terms of US debt, any projection greater than 5 years always has an element of speculative nature. For example, one of the unexpected trends of recent years was healthcare costs rising much slower than many people had predicted. Not least because one reason is that life expectancy in the US has fallen, which has reduced costs of an aging population. And it also is quite possible that something like Ozempic or some technological breakthrough could make a revolutionary change to the US chronic health conditions, which reduces costs for the government. But equally, projections that debt may do better than expected could also go the other way. One of the elephants in the room is the world, and the United States in particular, is seeing many more much extreme weather events that are really costly in terms of both insurance and federal emergency funding. But one thing is for sure, after 2025, the dollar will never be quite the same again. Now, if you want to see what it looks like if you do have a 100-year relative decline in the economy, take a look at the UK. Maybe that's a foretaste for what might happen to the United States in the next 100 years. Thanks for watching. Consider subscribing.